up, guys? Welcome back to Everyday Money. I'll tell you what, one of the funny things about YouTube is that I'm recording this today, and I just shot like 5 or 6 videos in a row over the last week or so because I'm headed out to Vegas from Cincinnati for like 2 weeks or so. And by the time, it feels like I'm talking to you live right now, but I'm actually going to be talking to you in like 2 weeks. So let's get on with the thing that we're here for today. Now, I mentioned this in a lot of the videos that I have done, especially ones regarding index funds, total market funds, stock market investing, things of that nature, that I love total market index funds, be it VTSAX, be it FSKAX, to a lesser extent, FZROK, the zero fee one from Fidelity, and I'll do that in a separate video why I'm not as keen on that one as I used to be. And there's a lot of reasons why I like total market funds versus any other type of index fund or sector fund investment. And I wanted to get into the 5 reasons why I like these and put this in a video so you guys know exactly where I stand. So we'll go down these in a descending order, with one being why I like it the most, and that reason is diversification. Everyone always tells you to diversify your investments, be it in the stock market, real estate market, among a whole bunch of asset classes. So, don't just be in stocks, be in real estate, be in bonds if you want to be in bonds, have some cash, invest in some other things like maybe luxury watches or collectible firearms or something like that. But they always say diversify. And if you try to put together a diversified stock portfolio, you're going to have a tough time, especially right when you're starting out, being able to adequately diversify yourself in stocks. Because if you try to get, let's say, one stock from every sector, you would end up probably spending at least hundreds, if not thousands of dollars trying to just get one stock from every sector. And that would still leave you pretty exposed to just one company in every one of those sectors. So what you can do with a total market index fund is you can buy the entire U.S. market. And when I talk about this, I'm talking about the U.S. market. You can buy total foreign markets, total bond market. But for the purposes of this, you buy all of the companies in the United States that are investable in one fell swoop. And that can be as cheap as the price of one share of an ETF that tracks the total market, like VTI, or if you are getting into a mutual fund index fund like VTSAX, you might need $3,000 in order to get into that. There are other total market funds. I believe FSKAX is also a $0 minimum or a $1 minimum. But I know that the FZROK free one from Fidelity is you can just put in just $1. So with that one trade, you can diversify yourself to the maximum extent that you can with just a single trade. And I think that is what makes total market funds one of the best stock market investments that you can make. Now, all that time that you're not spending researching stocks gives you plenty of time to smash the like button for the YouTube algorithm. So just look down there and just blast that little dude. The second is that they are very easy to use. For example, if you did try to go out and get all of those individual stocks in individual sectors, you'd have to research hundreds, if not thousands of companies. And to be honest with you, most people just do not have the time for that between jobs, spouses, kids, sports, hobbies. Most folks don't have the time to put in the due diligence to even pick 1 or 2 companies to invest in and have a reasonable expectation of return. So being able to purchase just one trade, buying one fund to get all of these companies makes it very easy to use a total market index fund. In addition, ease to use is also legitimately easy to use. All you have to do is go into your favorite financial services provider like Vanguard, like Fidelity, like Schwab, and find the fund that you want. And once you've done the research on what particular fund you want, and really most of these total market funds should perform almost identical, be it from whatever financial institution that you get. You just go in there and you click a button and you have purchased a portion of the entire US stock market. And then once you've gone on and you've let it go for as long as you want, be it, under a year and you want to pay short-term capital gains, over a year so you get long-term capital gains, or as I like to use these for is my extremely long-term investments. So 20, 30, 40 years, essentially stuff that I'm going to have the rest of my life. Whenever you're ready to do that, you do that same click and you have now sold those. They will, in some cases, take taxes out, but they'll send you all the tax forms that you are going to need to do your taxes, and it's that easy. So you can just research one firm, make one click to buy, make one click to sell, and you're all done. If you try to make individual stock purchases, again, you're going to have to, buy a whole bunch of companies, buy a whole bunch of companies. You're going to have to decide which ones you want to sell when you want to sell it. Or compared to like real estate, where you have to look out for properties, get pre-approved for a loan, find something, do the inspections, negotiate with the seller, come up with tens of thousands of dollars or hundreds of thousands of dollars to get to closing, close, rent it out. It's worth it on the real estate end, but as far as easy to use, it is very hard to beat the total market index fund. Third to the party is that they are, in general, low cost. These are passively managed funds. For the most part, computer algorithms run the fund so that it matches the stocks that it has in it to whatever the total market is at the time, and that makes the cost to administer those funds extraordinarily low. For example, VTSAX has a 0.04% expense ratio. FSKAX from Fidelity has a 0.015 expense ratio off the top of my head. And then not only just on expense ratios, but the fees are usually free, especially if you go through each individual company that provides these funds, like for example, Vanguard for VTSAX, Fidelity for FSKAX. And then on top of all that, it's low cost because you can just buy that one fund again. Like I was saying earlier in this video, is that if you would try to make a diversified portfolio out of individual stocks, and especially if you're just getting started and you only have $100 or a few $1,000, you don't have $10,000 to $100,000 to spend on a lot of stocks. If you tried to make a diversified portfolio of individual stocks, it would cost you a lot of money to get into those stocks. Whereas if you get into a total market fund like VTI, it is only whatever the cost of that ETF is at the time. Other financial institutions will even let you get in with as little as $1. So all together, it is extremely low cost for any type of investment, especially comparing it to like real estate, again, because I'm a real estate investor, so I always compare stocks to real estate and such. But it is extremely cheap versus getting into that, and it is extremely inexpensive versus setting up your own portfolio of individual stocks. Next up is the predictable results that you're going to get from a U.S. total market index fund. Now, since the returns of the stock market have been being kept track of since sometime in the 19-teens or something like that, the market has returned on average about 10%, including growth and dividends. And now, when you think about that, that includes the Great Depression, the 70s stagflation, dot-com bust, the 9/11, the credit/housing bubble bursting, the coronavirus panic and pandemic. From somewhere in the 19-teens to the present day, the market has returned on average about 10%. And then if you've been an investor in the last 10 or 15 years, the market is returning somewhere around 13 to 15%. Now, can that be sustained forever? Will we go back to that average of 10%? Or are we going to enter a period where it's less than 10%, but it still averages out? No one knows that for sure, but if you look at the past history of the past 100 years or so, and granted, past history doesn't necessarily predicate future performance, but it's as good of indication as we have, available to us, you can say that your total market fund will probably return right around 10%. And that is a solid base to put in. And if you can, know that you're going to get about 10%, and you can put this in as your core investment and say that you put, 80% of your funds into this, and that you can get that. That puts you in a very strong position to make other investments that are more speculative. Maybe you put money into whatever meme stock is is trending right now. Maybe you just want to get into a specific sector. Like, for example, the last 2 years from when this was recorded, this is middle of March 2021, but tech has exploded. It's been like 100% return in 2 years. Everything with the coronavirus pandemic has made online communication worth even more than it was before. You can do that if you have that core investment that you know is going to return. You can bet some money on some real estate if you are hesitant about getting in that because everyone told you you would lose money, even though you probably won't. You can use that core as a confidence builder, as a bank of cash that will let you be able to go out and pursue things that might be sexier or more fun or just more interesting to you. Because really, when you get right down to it, total market index funds are pretty boring, but they're super predictable. And now fifth, and this is going to be kind of probably different from what you've heard, but fifth is that U.S. total market funds have a pretty significant amount of foreign exposure. So if you are interested in getting into foreign markets, but maybe you didn't want to because for the most part, the foreign markets lag the United States market. That's just the way that it has been so far. But you're thinking, well, maybe the U.S. is at a peak. I don't think that's the case, but maybe you think the U.S. is at a peak and you are thinking about getting in some foreign stuff, but you just look at it and you're like, they return quite a bit less and I want to get the most return for my money. But if you think about it, a lot of the companies in a total market fund, for example, you're getting all the S&P 500 companies, 500 biggest companies in the United States, but even outside of those 500 companies, a lot of those companies in that total market fund are going to have significant foreign exposure. There are companies in there that have essentially that are worldwide companies, but they're just based in the United States. Google, Facebook, I mean, all the tech companies, Amazon, and then vehicle manufacturers, Ford, GM. There's companies all over the total market that are just based in the United States, that probably ones I can't even think of off the top of my head, that do business globally. So you are going to end up with a ton of foreign exposure with one of these U.S. total market indexes. And that sounds kind of backwards and it sounds like it's kind of silly, but if you think about it, a lot of the world's major companies are based in the United States, and so we just end up with a lot of foreign exposure. Guys, those are my top 5 reasons why I like total market index funds. I think that they provide a fantastic value to the stock market investor. I think it's a great place to put your core investments so that you get a predictable return. You're very well diversified within the stock market, and I think that's a great place to stick your money. If you guys like this video, be sure to hit that like button for me. It really helps me out in the YouTube algorithm. If you haven't subscribed yet, be sure to subscribe. I appreciate you guys watching, and I will see you next time on the other side of Vegas if I have any more money.